Good afternoon from Turkey. It's 3:58 p.m. in Turkey, Izmir, in the afternoon, and it's a beautiful, very windy, extremely windy Saturday in Izmir. Uh, Today, I'm preparing this video mostly based on some of the comments I made this morning in my Turkish channel. My Turkish channel, and most of the viewers are from that channel as well. I have about 286,000 subscribers, and they are watching my videos roughly about 100,000 every day. I'm getting a follow up. So my English channel is quite new. It's only 23rd, not even a month long. It's already got about 9,000 viewers or subscribers. So 88% of my subscribers are from Turkey. 12% of my subscribers are from other countries. The second following is United States, then Germany. So there are many, even up to Thailand, Qatar, and hello to all. Anyway, so let me get back to the what's in the thumbnail that I explained. First of all, Fed may never hit. Why Fed may never hit the 2% target? I just explained this morning. The DXY, which is a calculation of the value of US dollar against a basket of well-known currencies like euro, Japanese yen, Swiss franc, British pound sterling. So, but the heaviest part in that basket, the US dollar is compared, consists of euro. About 56-57% is made up of euro. So when we are comparing value of US dollar, it's a fake. It's a fake because we are comparing it against other currencies. They are also the dirty laundry in the basket. All of them have inflation. Only I checked today, the lowest inflation rate is in Switzerland, about 2-3% inflation. So this tells us all that inflation. Uh, uh, Hello, Eren. And this tells us the inflation is not a cause of supply problems. Oil prices went up. They went all over the world. Supply problems were all over the world. How come Sweden, Japan, and China only had 1 or 2% inflation, and US and European countries had 10%? Forget about Turkey. It's been always very high inflation. So the main reason is a lie, which is like, as I always repeated, and I will always repeat, it's the amount of money and monetary expansion, which includes printing money, paying your debt with printed money, and expenses of governments being paid by printed more money, and opening a lot of loans to stimulate the economy, so that suddenly money pours in, and suddenly there are only few items in the market, but a lot of money. So prices start hiking. They don't start hiking in the same time at the same quantity. They may go up by in some items 20%, like eggs in the United States. Some may delay, like houses, maybe just due to other interest rate problems. The heavier, bigger items, they come later, but they definitely come in time. So you can be sure, as an inflation expert, living in an inflationary environment, not hyperinflation, but very high inflation. So hyperinflation is something else. It's like a daily 1,000% or something. So we don't have much hyperinflation examples now. Even Argentina is not. But the calculation of inflation today, as I told before, is made from prices, which is wrong. because prices are the result of printing or expanding loans and printing too much money. They are not the reason for inflation. So, as many say, if you see snow on the sidewalks, uh, it's not the sidewalks that make the snow. Okay, it's the snow that went. So it's the prices are the result on the sidewalk. The real reason is the snowing clouds, let's say, in the weather conditions. So it's same. The prices are just the lagging indicator, or of how much money is printed, basically. So trying to stop it by increasing interest rates, it does it does help to slow it down. It does not cancel it. They have to take back all that money, which Fed is doing. They took back about $1 trillion so far, but they printed eight. So 1 trillion can only help this much. And now, as they bought their own bonds, the bond prices went, uh, they kept not buying the bonds in the meantime, not to renew the loans. So the bond prices went down, the interest rates went very high, because Fed is the only buyer of the American loan, the main buyer. Also, countries like China, Japan, who hold big amounts of American loan, they also started selling because they are losing value. So who will keep a value losing item? Only maybe upon agreement they can say, I'll hold yours, you hold mine. It's because they are all friends. Anyway, but up to some point, then they cannot bear the loss. So now what will happen is, yesterday, after the Fed meeting, the let's say the economy market are convinced that Fed will not hike the interest rates much further. Maybe the next meeting is in December 13th, the announcement of the interest rate hike. That's just before Christmas. So they've been skipping for 2-3 times. They may skip the third time. What difference will it make? It's like just psychological, 0.25. If 5.50 doesn't help, 5.75 will not help as well. It will not stop inflation if it's just increasing the interest rates. So what's happening right now? That measure, which is a basket of other bad laundry of the other currencies compared to US dollar, started gaining value, and dollar started losing value against them. That's called DXY. So DXY have been coming down from 113. Recently, it was around 106, 107. Right now, it's 104. Don't worry about the measure. Just worry about that dollar value is eroding. Why is it eroding? Well, if you give high interest, people will buy your money. It's like, will you go deposit your money at a bank that gives 1% interest, or if it's guaranteed by the Fed or the insurance agency that they're going to pay you for sure, like the 400,000 US dollars, and this bank is paying you 5%. You'll go to the 5% one, okay? So similar is happening. Now they are going away from US dollars to others, which are paying better. This way, now, if this was happening to euro, Australian dollars, Swiss francs, that wouldn't be a big problem. And the real big problem is US dollar is the reserve currency, which all the commodities in the world are calculated on, with one exception. The wool is calculated on Australian dollars only. The barrels of oil are on dollar calculation, like $85. The gold is on, roughly around $1,990 or $2,000. So these are all calculated on dollars. And think of it as a scale. If you decrease the value of US dollar, the goods which are expensive and tangible means dokunable in Turkish, which are tangible. So they say I'm not dumb enough to give myself out cheap, you know. So gasoline, oil says, I'm not going to give myself to cheap US dollar. So they will start adjusting their prices upward. So it's very normal, even if there is no war and nothing. If US dollar is losing value, gold prices will increase, barley prices will increase, tomato prices will increase, whatever is imported, prices will increase. All the imports from China, they will increase in for a US citizen who lives in the United States, okay? Because they earn in US dollars. For a Turkish person, it may not be important because if the value, so at least value will stay the same because oil price will go up, dollar will go down. So he's basically buying it almost at the same price. So in his currency. So, but US dollar has a unique situation. It's the reserve currency. So that makes it vulnerable suddenly for Americans. Now we are saying the inflation that came down by the interest rates. Now, when this is stopped, suddenly we will see a huge jump in prices of the products that Americans are buying because US dollar will lose value, okay, is losing value. So the commodities are gaining value against Americans, okay. So that means if they stop it, so I'm assuming a harder drop to just to make you understand. If US dollar DXY drops 10%, 20%, the gasoline prices, barley, eggs, meat, anything imported from overseas will go up 20%, okay, for an American, which means because they are calculating the inflation from the market, all prices will go up again. So United States and Fed may never see lower interest rates for the future because the value of, so they must be careful to move the US dollar value, DXY, very slowly down, 104, 103 and a half, 105, 106. So that's why they knew that inflation was about 9%. Why didn't they just go ahead and increase it to, 5%, 4% suddenly? Because then the value of the US dollar, okay, will suddenly change when they start cutting the rates, okay? So that's a big problem. Inflation return of the living dead, zombies will return to the USA. So I hope you understood. So now, if the prices in the gold, that's why yesterday all the commodities, including oil and gold, and also the US markets, responded by increasing in prices for 2 days. Why the stock exchange? Well, every stock sort of has something tangible on the backside. Like if it's a stock of Coca-Cola, it means it's the Coca-Cola factories, land, brand, pricing, everything. So if it's a steel company shares, it's a, steel companies, plants, land, sales. Of course, it's more complicated, but basically, at first, they will lose value. But with inflation, this is exactly what's happening in an inflationary environment in Turkey. The prices of when during a sudden jerk in price of the US dollar or fall in the price of TL, the gold and other foreign currency based items take the value the next day, the same day, okay? But the stock exchange cannot catch up with it. Same as houses, because houses are not priced in US dollars in Turkey. They are priced in TL. Cars are not, well, cars sort of, because they at least start importing the next month. 2 months later, the new prices, they adjust according to, but also the stock exchange prices first stay same, then suddenly start going up because they want to adjust according to inflation as well. So this may not be exactly, if inflation is 20%, it's going to match the 20%. Some of them will go past it, and some of them will oversell. Some of them will stay a little lower until a new balance is formed. So I guess you got my main idea. This way, as rates keep falling, the Fed loses control of the prices of importation, and all the commodity prices in the world will go up. So they are trying to cause a recession, and recession, worldwide recession. So why are they causing worldwide recession? So that the competitors who are going to sell US, the commodities, they can say, oh, not much people to sell, like yesterday, the Maersk lines from, it's a shipping line from Denmark, I mentioned you yesterday, said, I'm kicking out or letting them use jobless benefits 10,000 workers of the shipping line. So that means there won't be much to transfer around the world. We are going to recession, so not much products to sell, which is an extreme action, because I'm not afraid of recession. Recession is in fact very healthy, because it's correction of all the mistakes made in the past. It's a correction stage, but you don't want to be hurt by that. So you want to take position against recession. What should you stay at? Gold, okay, mainly because gold is a recession killer. Why gold is a recession killer? Well, it can be any tangible asset. In actuality, it can be silver, barley, but oil, you cannot store them. Gold is easy to store, first of all. It's easy to cash anywhere in the world the next day. So that's why governments are buying record amounts of gold. This past month is, or the 2023, is the record gold buying by the central banks. It's announced by the Gold Council. So it may end up the year in 2 months' time, less than 2 months' time. It may be the highest amount of gold bought by governments, not people. People are not buying as much, but governments are buying because they are replacing US bonds as much as possible with gold, because gold is more dependable than US dollars. And if they need loans, they can just give their gold as a collateral, like put it in London, and get US dollars if they need to. So if you have gold, you have money, you have collateral, very strong collateral. It's like getting a mortgage against your house. If you have a house, you can easily get a mortgage loan. But if you have as the items go down, like a car, like, piano, they won't give you a big loan against them. Okay. So they are not worth as much as a house, land, and gold. So they are good collateral, very strong collateral. And US bonds are good collateral considered because they are the reserve currency. So everybody will need them to do business with each other. But as I said, when people are escaping from US dollars, what will they replace it with? Chinese money, Australian money, Canadian dollars? No. Or European euros? None of them meet the criteria. Okay. So they come to commodity type of assets. So secondly, based on this calculation, I attached a link in this video, in the explanation section of this video. It belongs to official US government Bureau of Labor Statistics, where they calculate the official US dollar calculation. Now, this is the second topic I want to mention. It's been 19 minutes. If you're watching this later on, not from a live show, you can always speed it up, to like 150, 175. So, because I'm not recording like others and then speeding it up, so you can say, this guy is talking very slowly. That's not the case. If I record them and if I speed it up before I load it to the YouTube, then you will think that I'm speaking very fast, back to back, very smart guy, speaking very quickly, That's not the case, okay? I'm not reading from anywhere. I'm just reading from here. So The second thing, as I mentioned, is the charts. Today, I watched this morning many charts in many different channels because the S&P, NASDAQ, and this and that went up. So they started showing 20 years ago trends. Those are garbage. I tell you, those are all garbage. Why are they garbage? Because the $1,000 shown in that 10 years ago, 13 years ago, has nothing to do with today's US dollar value. So they say, as you see, this was a pivot, this was a pivot, this was this. So that's the resistance point, and this is the, so it's nonsense because they are not talking apples to apples. They are comparing apples to peanuts. In the short term, I'm a technical analyst as well, but I only use it for like a weekly, at most monthly, let's say 3 monthly. I would never go 10-year, 20-year back and say, okay, now this is the area. So like for gold, if you look for long term, you will see a chart that's shaped like a pen. They call it coffee cup or pen, pot pen. And the top section and this middle means when this coffee cup and the handle will be as tall as this amount, which is the height between the tip of the and the base of the cup. So you're expecting sometime that much increase. So if this is like $1,600 for gold, and if it's $2,000 here, you can have $400. So it's going to be $2,400 when this reaches. But as I said, if you apply inflation to that chart which looks like this will look like this, nothing close. I just put the link so you can do your own calculations, but I made one for you. 1,000 US dollars in September 2023. That's the latest they entered. They don't have October yet because we are running October. No, we are running November. Yes, November. So it's lagging 1 month behind. They enter the inflations of the month. $1,000 in September 2023. I calculated the value of $1,000 in September 2010. You can use this chart upwards or downwards. You can put either like what does $1,000 worth today? So you write September 23, then September 2010. So it tells you it's worth $709.70. So $1,000 today is only $710 of 13 years ago. So I use this calculator for calculating price of gold. Like 3 years ago, 4 years ago, gold was $1,800. It was up and down, but the main, center was $1,800. So I checked if that $18 equivalent today, because of the inflation in only the 3 years, it says $2,030. That's the base, because $1,800 was the middle. So it went up to $2,000. So I can say this. What if it goes to $2,000? It automatically calculates me $2,240. Okay. So similarly, you can calculate like I bought this house for $100,000. So I wonder how much money I made in this house. If you assuming you paid it cash, then you can find out that this house, if it's still worth $100,000 without any increase, you actually lost money, huge amounts of money. Even the house is now, instead of $100,000, let's say you bought it in 2010, and in 2023, the house is, instead of $100,000, $120,000. You can say, oh, I made $20,000. But when you put it in this official calculator, it tells you you lost $200,000 because your money is actually $140,000 it's worth today. So, of course, you should add the rents and other benefits you made, or if you invested in mortgages, just paid a very small percentage at that time and paid in installments. Profits exceed, especially in real estate, they exceed. and you get much better returns in that sense instead of buying cash. So if I had money in States, instead of buying a cash house, a house for a cash, if I had enough, let's say, credibility, I would buy 2 or 3 houses instead. Just pay more cash payments and monthly payments. The renters will pay. I may add up a little bit on top of them. And so in 10, 15 years, I will own majority of these houses. So if I sell one of them, both houses will be my free of any loans. Okay. So instead of having one house 30 years later, I can have 2 houses in 10 years. So I apply this situation in Turkey. And it's even better because inflation here is very high and you get a fixed mortgage asset. Fixed monthly is very important. Variable is very dangerous. Don't get variable. And so you pay fixed amount, and in like 3-4 years almost, you get a 10-year loan in Turkey. 4 years later, the house is paid for. You have about $2,000 to pay to close your mortgage if you like to. So little. I mean, so little amounts you can buy an apartment building. Within 3-4 years. So same is happening in US, just as a smaller sample. It's the same thing, but at a smaller scale. So the house prices are increasing or staying same, while the mortgage rates are up to 8%. Well, you can be sure if those mortgage rates start coming back to 6, 5, 4, those houses for every 1% will go up 10%. Okay, so if it comes down from 8 to 3%, the house price right now $400,000 will go to $600,000. So that's why I'm saying you should not think of this is too expensive credit, especially in US. I will not delay if it's a good market for a buyer's market. If Fed succeeds, fine, they will lower the rates. You can just go ahead and refinance it. If Fed does not succeed, fine, you have a better rate anyway. Now the new rate is 12%, and you got your loan at 8%. So that's still no problem. Okay, so I hope you understood that all the technical, when you are seeing in other channels, technical charts, the patterns, this and that, all economic channels, if they are exceeding 6-7 months, let's say at most a year, because year is about loss is about 5%, 6%. It's not something you can ignore. It's important. But when you're talking 20-25% in 3 years in US dollars, your $100,000 is worth only 75% of what you initially invested. So when you look at the prices of gold today, $2,000 is equivalent to 4 years ago $1,800. Okay, and if you go further back, it's $1,650. If you go back longer, like to 1,200, 1,400 US dollars at that time, I check it in all, because what I'm saying, the 1,800, if it was just for a day, you can say, oh, that was a day when it was overpriced. So I calculated with a majority like 2 years, 3 years. That's why I gave you 1,800 example. Okay, I could have given you 15, 1,200, and years go back. You can check it out as well. So I don't want to see gold overpriced or lower price just because I want to buy gold and I wanted to see 3,000, 5,000. Is if inflation continues, like I mentioned in the first part of this video, because of US dollar losing value against all the other countries, and this will go into the prices of the American consumers. That means this is going to speed up. And don't forget, the numbers we are checking are from Bureau of Labor Statistics, which are not dependable in many countries, because I know in the US they have shadow stats, which calculates based on the older inflation calculating basket. It says multiply by 2. So if the government or the BLS is announcing 9%, that's 18%. Okay. So because there is lots of fakes there, you can apply. You choose numbers from, for example, 1/3 of it is the house rent. And house rent, they don't collect from, real estate sites. What they do, they go to a person who didn't rent his house out. Okay. So they ask, what would you have rented this house if you wanted to? I don't intend to rent it. Well, assume, you want to rent it. He says, okay, $3,000. They write that down, and that comes into your inflation calculation. All lie. Similarly, yesterday, the worker numbers, which have been, losing their jobs, getting benefits of, losing jobs, and entering the workforce was only 150,000, but or losing their jobs. So when we calculated from the home wise, it was 350,000. Okay, not 150,000. Well, where does the big difference comes? Difference comes from they asked the companies, how many employers you added this month, how many employers you added. Let's say I added one, I added one, I added one. And then they check the home, says, do you have a job? They says, yes, I got 3 jobs. No, don't worry. That will count you one. So that's where the big difference comes from. They ask the companies, they say, yes, I employ one, I employ one. When you go to home, it's same person working as a cashier, then flipping hamburgers, and nighttime serving as a waiter. Okay. So the numbers you got yesterday for 150,000 is bull. Okay. Bull, Spanish bull, like this one. Okay. And okay, I hope you had a nice Saturday, and be careful. Don't take anything shown to you by its face value. Just check what's underneath it, then invest accordingly. Okay, don't get fooled by the senior analyst, this and that. Okay, because if they are senior, they would have shown you inflation adjusted chart, not a regular chart. See you all later. Have a nice day.